that was supposed to cover my time during national service, where she would also be able to stop paying once I started work, and then the insurance would be self-funding. Unfortunately, when I started work, the letters for the premiums kept arriving until I tried to lodge a complaint with the company. And the company basically gave us two choices. Either you um, surrender the policy and let it lapse, that means you stop paying, or you continue paying for an unknown period of time, right? And so I wasn't aware that there is a dispute mechanism for insurance cases. So at that time, we took the option of stopping the payment of the premiums. But the entire experience left a very bad taste in my mouth. And maybe because I'm lucky that way, uh, I refused to entertain any phone calls from my friends who became financial advisors. And you can argue that this may be one of the reasons why I was able to generate such a high passive income at an earlier stage of my life, right? Uh, for most of us going through spring, I think one of the issues that we have now is that personal finance is not taught very well in school, right? You're taught to be an obedient employee, like my generation, and the consequences of compound interest is not demonstrated to secondary school students, all right? Unless you get someone from the private sector to come in to teach them things like the rule of 72, a lot of students go through life without really understanding a lot about how to handle money, right? And of course, nobody understands how crippling it is to pay all these expensive sales expenses for investment products, right? And I think that is another reason why I distrust financial institutions, right? Because of high costs. So one question you want to ask yourself is, in that case, how do we pick up crucial personal finance skills that's important for our lives, right, during spring? Okay, and one of the answers that even secondary school students today, right, I spoke to some kids, some teenagers from Raffles Institution, and they know who Robert Kiyosaki is. They know how influential this author is. And 20 years ago, I sort of read up on this book, Rich Dad, Poor Dad, and I was also very, very motivated by this series of books, right? Purple-colored books by Robert Kiyosaki. And that was very exciting for that time. But having read it and then subsequently reading his second and third book, I realized that he begins to repeat himself. And overall, you don't really learn how to invest. Okay. And until I read his fifth or sixth book, The Business of the 21st Century, it was then I realized that actually Rich Dad, Poor Dad, Robert Kiyosaki is a creature of multi-level marketing. And his job is to subliminally program the readers to be more open-minded to the idea of network marketing or MLM, to promote these MLM products. And I think for the folks who are around my age, you know how bad MLM is, right? You've got people who are jobless, they pay money to distribute some goods, and then they then get people to form a downline, and they promote these very expensive and non-competitive products out there in the market, right? And it's actually made people lose friends, you know? Yeah, so generally speaking, if somebody invites me for an MLM talk, I will normally unfriend that person. Okay, right. Yeah. So if you actually go further than popular finance books and you study for a diploma or degree in finance, the situation doesn't get a lot better, because the nature of financial models is that they have a tendency to be quite subjective. So the discounted cash flow formula that I put here, which is Finance 101, when they teach finance to students, maybe first-year students, they require that to value an asset, you need to do two things, right? The first is to project your cash flow to the future, which is very difficult, right? Can you imagine what it's like to imagine a pandemic 2 years down the road, right? If you're the CEO of SIA, that's very hard, right? On top of that, you must discount these cash flows into the present using a particular interest rate, all right? And this is also very subjective. What number do I use? The inflation rate, you know, the rate for local bonds, weighted average cost of capital, right? So if you have multiple analysts projecting different cash flows and using a different discount rate, you will find that there is a very large variance between the assets the valuation of the assets that they use to value a particular product. And as a retail investor, you find that it is very inconvenient because sometimes when you're looking at a company and there are many analysts looking at it, some analysts would say buy and some analysts would actually say sell, right? Yeah. So who is right and who is wrong, right? And I think that is one of the fundamental problems about investing today. Is this subjective valuation when it comes to the intrinsic value of a particular stock. So to learn finance the right way, I recommend that instead of reading Robert Kiyosaki, you read this book by Josh Clayson called The Richest Man in Babylon. All right, you can take a photo of this slide, okay, and you can go to the library to pick up this book. If you want to know further after reading The Richest Man in Babylon, then go ahead and read The Conceptual Foundations of Investing by the Cornells. It is probably the shortest introduction to investing that people have not heard about. So these two books are not exactly very popular, all right? And you can then move on to the more popular books on investing, like The Intelligent Investor or The Random Walk Down Wall Street, all right? But these two are the first two steps for beginning investors, all right? And to summarize what I've spoken about in spring, this is about the importance of personal finance as a life skill, and somehow it is neglected in our education system. And because of this, right, well, that's how I actually earn a living, right? I equip people with skills on personal finance, right? So that's how it works. All right. The next season is the season of summer. And most of you listening to me today are going through this season right now. And this is where you spend most of your time making your money. And this is where you start a family at this stage, right? For me, I was unfortunate enough to be in IT in the early 2000s after the dot-com crash. And then there is a wave of outsourcing that saw many engineers like myself, become very vulnerable to job losses, right, through outsourcing. So one of the decisions I made when I was much younger was that, if there are going to be job losses, I should be the one, managing the restructuring process. So what I did was I became an outsourcing professional, right? So much like the Squid Game person in purple here, my job is to document the processes of an IT team. And then I would fly overseas and I would train a team of engineers from Kuala Lumpur. And then they will replace the team in Singapore. But I wouldn't end there, right? I would then fly over to Bangalore and I would use the documented processes and I'll find a team in India to replace the team in KL, right? So I did that. I rinsed and repeated, and I did quite well professionally, right? Until one day when I was in Bangalore and I was actually preparing for another outsourcing project, I received an email that one of my colleagues in Europe, whose job was moved over to Eastern Europe, he sealed himself inside a room, he switched on a barbecue device, and he probably died of carbon monoxide poisoning, right? So he committed suicide. And it was at the time I realized that the work I do can be very deadly, right? People can die in the business of IT outsourcing, right? And so I decided that, there is certainly a lot of bad karma, right, when you run these projects. So the opposite of it is to figure out whether there's a cure, right? Of course, the cure applies for myself, but also applies to other people that might read my works, right? And that was when I started to spend my evenings in the data center, self-studying the Chartered Financial Analyst program and picking up finance at a postgraduate level very, very seriously. And that was when I discovered that the models in finance don't work particularly well until I was able to find this particular research paper by Robert Arnott and Clifford Asness, entitled Surprise, Higher Dividends Equals to Higher Earnings Growth, right? And in 2003, it won an award for the best research paper, right? And what does it say? It says that the historical evidence strongly suggests that expected future earnings growth is the fastest when current payout ratios are high and slowest when payout ratios are low. Essentially, what they're saying is that managers who return money to the shareholders tend to be more down to earth. They don't engage in empire building. They don't abuse the cash hoard that they have, right? So you don't see things like decorating offices with art. installing golden taps in their toilets, right? And over time, these down-to-earth managers grow the companies faster than those very vain kind of managers who like to do good, right? Yeah. And after reading this paper, I decided that, maybe it is time to move on from theory to practice. So this is what I did when I was in my 20s, right? I began to liquidate all the unit trusts that I have. And I started moving them into local companies that paid the cash flow, right? A company, for example, that was good then, not necessarily good recently, was SPH, right? It was trading at around $4. It gave a dividend of about 6% every year. And I get about $150 for every 1,000 shares I have, close to my birthday on Christmas Day, right? You can imagine how life-changing that was, right? To be able to receive a birthday present just before your birthday, and instead of looking for money to pay some insurance premiums, right? Like in the past. So I felt that my life has changed, right? And that was more than 20 years ago. And you can imagine, right, that there wasn't a FIRE movement back then. But I realized that I could structure my life around this concept of financial freedom, right? I have expenses that I have as a bachelor, right? So it's a horizontal line, but it's around $1,000 a month, right? As a bachelor 20 years ago. That's a decent sum of money, right? Including like rent I pay to my parents, paying for my income tax. And then at the same time, I have another line that measures my monthly passive income. Of course, it starts very, very small, but eventually, right, it would exceed the amount of expenses I need, right? So essentially, once I get this crossover point, right, I would be financially free. Okay, and there are two ways I could do that. I could obviously buy more stocks, accumulate more dividends, but I can also reduce my expenses as a single bachelor, right? And I was able to attain that quite early in my life at the age of 32, right? And so that sort of summarizes, right, generally how this method of early retirement works, right? You look for assets that give you a regular paycheck, and then after that, you use this regular paycheck to try to sustain your very basic kind of lifestyle. Okay, and so when it comes to your life, right, for Summer, your work is understandably not as engaging as in the past, right? When companies are not growing and Singapore's GDP growth is between 2 to 3%, right? It's no longer the boom days that I had when I was an IT professional, right? And so now the people in China and the people in the US, they're thinking of alternatives, right? A lot of them want to work from home. They don't want to go back to the office. And China has a lie flat movement that has become something else altogether. Right now, there is the Bailan movement, right? They call this. And younger people in China are not as engaged as before, right? So a large amount of people who come for these financial talks want to ask themselves, if they want a more relaxed kind of lifestyle, instead of slaving so that your boss can get a Ferrari, right? How do you go about structuring your life to do that, right? On top of it, in summer, financial institutions want to tell you that they have a solution to your problems, right? They want control over your investment strategy, and they have a team of very motivated pool of supporters who make commission from sales, right? To talk to you constantly, get you out of McDonald's where they can sell you investment-linked policies, right? And it's sort of alienated an entire generation of people, right? Yeah, and then while you're working, right, your knowledge is also becoming less and less valuable over time because of things like ChatGPT. Okay, you find that your half-life of your knowledge is now maybe less than 6 years, but the mortgages that you have still takes up 25 years, right? And you do not have a lot of time to earn your keep in this modern economy. So you earn the most money at this period of time, you're at the peak of your energy, but if you spend too much time indulging in your lives, right, likely you will pay the price later on. All right, and so the myth in summer is retirement is impossible, unless you listen to some kind of a financial advisor. I think that's what the paid professionals want you to know, all right? Now, before I can sort of explain to you how retirement works, I need to talk a little bit about what do we mean by retirement, all right? And so there are three things that we need to know about retirement before we can proceed. The first is why you need about $500,000 for a single person to retire. And how do we derive these numbers, right? Academics in the Lee Kuan Yew School of Public Policy about 3 years ago said that a single person at the age of 55 would need about $1,768 a month, all right, to live a dignified kind of life with a reasonable basket of goods, includes entertainment, all right, includes entertainment. And when you multiply that by 12, right, and then you divide that by 0.04. Now, why 0.04? This comes from the finance industry. The idea is that if you're a millionaire, you can spend 4% of your money or $40,000 every year adjusted by inflation. And you won't run out of money for the next 35 to 40 years, which is enough for people to do retirement planning. All right. So we take this number and we crunch it and we come up with about $530,000. All right. So I can say that if you want to talk about early retirement right now, you have to find a way to accumulate $500,000. And then after that, you're sort of financially free. All right. You're sort of financially free. That's the target that you want to attain. All right. Next, you don't have a lot of time to actually do this. All right. If you start work at the age of 25 after NS and a 4-year degree program, you will spend a number of years doing some exploration, finding out which corporate cultures are suitable for you, right? And then after that, you might get a master's degree, and by the time you sort of settle down and you start making real bank, right, you might be 30 years old. All right. So most people go through a period of exploration. And the thing about Gen Z is that they are maturing at a much later time, right? It is delayed adulthood, so to speak. All right. Now, but you look at the people who are getting retrenched today, millennials are starting to get retrenched because the older millennials are already at the age of 40, right? It's no longer my generation getting retrenched. My generation have problems finding a job, right? Yeah. And so if you were to put everything on a timeline now, you find that you only have about 10 years of uninterrupted work for you to actually plan for retirement. And that is a very, very tight kind of timeline, okay? Tight timeline, and there is certainly a sense of urgency when you're trying to plan for retirement. And of course, the third issue is that you can only save $2,000 a month, right? This is an assumption where you take the median income, adjust it by inflation, then you adjust it downwards because of CPF contributions, right? $2,000 a month is about 50% of your take-home pay. So if you're very aggressive about saving for retirement and you want to save for retirement, then maybe you have to set aside $2,000 a month, which is very hard for a lot of people, right? But if you're able to do this, then we will know whether whatever we have in the industry, whether it's amenable to aggressive financial planning, right? And so what I'm going to do next over the next few slides is that I want to look at what insurance agents have to sell to you along with retail bankers. And then we want to compare that with whether you're able to actually reach early retirement by using these commonly sold products that your friend will be happy to sell to you. All right. So let's look at the insurance products. And let's begin by looking at a simple endowment that pays an interest rate of 2% every year. All right. And suppose you set aside 2,000 a month or 24,000 a year here, right? We can use a compound interest calculator, right? We set the interest rate to 2%. And what we do is that we keep increasing this number of years to grow until the future value becomes $500,000, right? And we find that it takes 18 years for you to reach your target, which means that if you use these low interest rate financial products, right, it will take you 18 years for you to reach early retirement with an aggressive $2,000 a month kind of savings plan, right? Okay, so that's basically the short-term endowment that is commonly sold until recently, right? Then what about these long-term endowments? Now, they are only allowed to tell you that their product can give you up to 4.25%. And actually, most of their products don't even give you that kind of return. You go through the same process and to calculate, you find that your retirement plan would take 15 years at 2,000 a month. Okay, and finally, investment-linked policies produce a lot of commissions for them. They love shoving it down the throats of their customers. And what I've done is that I've been very generous. I've assumed that even calculating all your costs, all your management expenses, they still give you about 5% a year, which is actually very, very optimistic, right? Then we're looking at the time required to retire would be about 14 years, right? So that's the best the industry can give to you, right? So what about banking products, right? If you don't trust the financial advisor, what about the banker? And banks love unit trust, right? And the unit trust platform, I've been even more generous. I've assumed a 10% return, but because of management expenses, your rep fees and all that, we reduce from 10% to 6.5%. And you go through that same process, you find that you get out of the rat race after 13 years. And I must remind everybody that Singaporeans pay more for their unit trust than people around the world. All right. So it's a very difficult way of like sort of getting financially independent. And what does it mean, right? It means that if you surrender your financial destiny to someone else and you let someone strategically take control over your money, right? And money is such an important thing in your life. Why do you want to let someone else control it, right? If you do that, you will fail. And the reason why you will fail is because of this conflict of interest, right? They want to retire early, they want to earn your money, but you want to save your money to retire early. There is a conflict, and they cannot possibly give you advice that is the best for you because they need to give you advice that is the best for them, right? Okay, so with that critique of the industry, I'm not about to tell you that it's very easy to do DIY investing. Okay, I just want to remind everybody that it's also not a bed of roses when you invest on your own, all right? But I'll show you step by step how to improve your odds of early retirement, right? Improve the probability of that happening. So before I begin, I'd like to talk a little bit about the importance of understanding what a return and what risk is, right? When a financial advisor sells you a product, they will try to attract you by sharing with you what the high returns are. That's how they get a lot of people into AI stocks, technology stocks, and in the past, China stocks, right? Now, but what's equally important, and that's something that most financial advisors do not really like to talk about, is the underlying risk when you buy an investment. And that's demonstrated by a variable called the standard deviation of a strategy, right? The higher the standard deviation, the riskier your strategy. So you have something that is very, very tame, right? Your investment performance will be very close to the center, right? So if you give 7%, 6.9%, 7.1%, right? But investments like this are very rare. Typically, when you buy stocks, your returns will be all over the place, right? And so the distance from the center can be quite wide, right? And a lot of people don't understand that. They believe that just because they have a strategy with a high return, they ignore the risk. And as it turns out, the higher the risk, the lower the kind of returns, the lower your probability of retiring on time, right? And so to demonstrate that, I will stop my slides right now and I will share with you this particular program, okay? And it's very important that you know that if you want a trainer, your trainer should be able to code, all right? I use a program, I use this thing called a Jupyter Notebook. I program in the Python programming language, all right? And what this program does is that it allows us to visualize the effects of some of the financial decisions that we have, right? So in this example, we have 500 retirement portfolios, and there is always a failure rate. So suppose we have a system where you invest your money and there is a 10% chance that you will not retire with a single cent, right, on the day you leave the world, right? So let's see what happens if we can increase the underlying return. So you can find a strategy that gives you higher returns, right? What happens, right? What happens? And typically, the failure rate obviously goes down, right? You have something that gives you a higher return, you can retire a lot better. And you find a lot of these squiggly lines ending at a very, very high number, right? Yeah, but let's see what happens if we keep the return the same, but we increase the underlying risk, all right? So if you're able to do this, right, then what will happen is your failure rate goes up again, right? It can go up by quite a big amount, right? Yeah. And you find that while a lot of investments end up doing very well, many, many investments end up underwater, right? Which means that a financial advisor cannot tell you to buy a product simply by sharing with you financial pornography, like how much money you would have made if you had bought something, right? And that is something which I think is not a very good practice in the industry. Okay, so coming back, right? All the examples that I have for today discuss the Singapore markets, right? And the Singapore markets, to be fair, hasn't been like the best market uh, for the past 5 years at least. Okay, but there are several reasons why I really love Singapore. There are no capital gains or dividends taxes. Very, very important. Okay, whatever you buy and you invest in, the money comes in your bank account on the payment date, right? Without any like withholding tax. There are also no problems with estate planning if anything were to happen to you. If you were to leave your stocks in the US and something were to happen to you, right? It might track taxation. Maybe 30 to 40% might actually be taxed. All right, but you have to consult someone who's an expert in taxes to help you do that kind of tax planning. All right, so that's something you need to think about. Right? And given that Singapore is a value-driven, high-dividend kind of market, right? As the markets begin to drop, right, you find that actually the dividend yield becomes higher, and you can make more passive income when Singapore markets become cheaper. And it remains cheap today, right? With a price-earnings ratio between about 11.5 to 13, right? That kind of range. Singapore stocks are still in very, very cheap territory, and now some of the stocks are expected to do quite well when interest rates are falling. Okay, so let's talk about the first strategy, right? The first rookie strategy is I buy the STI ETF, the Straits Times Index Exchange Traded Fund, and I just buy this counter and I own all the big Temasek counters, 3 banks, 7 REITs. You've got DBS, UOB, OCBC, you've got like Capital Land, Ascendas REITs. You could also have things like SGX and SIA and Singtel, right? So what happens if instead of listening to a financial advisor, you make a decision 10 years ago, 16 years ago, and you buy the STI ETF, right? So as it turns out, not particularly good, right? You make 0.6% every year. Your volatility is relatively low, but it will take 20 years at this rate for you to retire on Singapore stocks. And this is the reason, right? This is the reason why people laugh at investors who invest in the Singapore markets, because they think that, you know, we have achieved very, very low returns over time, you know, and we don't know what we're doing, right? So if you look at these numbers, yes, that is the case, right? But the STI has some fundamental flaws, right? One of the biggest flaws is that it is capitalization weighted, so that when you put your money into STI, 45% of your money is in banks, right? UOB, OCBC, and DBS. And when interest rates are dropping, like what's going to happen over the next 6 months to a year, the banks are going to underperform. The banks are going to underperform, right? And so the overall STI does not look particularly good, right? So how do you improve your returns, right? You solve it by simply taking your capital, dividing it into 30 parts, and then investing each share in equal proportions, equal weighting, right? So $30,000, you put $1,000 into every share. And where can you find a list of the shares? Buy a copy of the Business Times, and there is a table like this where you can look at the Straits Times Index component stocks, right? You can do that, okay? Okay. Now, if you were to buy equal weighted STI counters, then for the same period of time, your returns would improve and your risk would actually drop. Okay, so this is how you can actually improve your performance, right? But the thing is that you must have some investment knowledge before you do that, right? And you have to buy these stocks individually, and you have to buy 30 of them, right? But of course, a lot of you are saying, well, maybe I don't want to buy 30 stocks. I want to buy 15 stocks that might outperform, right? And we can do this by factor selection, right? When we use the word factor, essentially what we're saying is that we are looking for traits, all right? Factor for company is traits for person, right? When we want to decide who gets into, for example, an elite school, right? Like the gifted education program, you look for a trait called high IQ, right? Now, if we are looking for a company that can give us the highest probability returns, we also need to look for the proper kind of trades. And some of the trades might include a higher dividend yield or lower price to earnings ratio, right? Now, suppose we go to the same STI article, right? And you can do that with tomorrow's newspapers or even the newspapers today. You will find a column called dividend yield, and you take a pen and you mark out 15 of the stocks that give you the highest dividend yield. All right, suppose you do that. All right, then the question is, in that case, what kind of returns are you going to get? So as it turns out, when you shortlist 15 of the highest dividend yield stocks, right, your performance improves to 5.4%. Your volatility goes up slightly, but that's because you're only buying 15 stocks, so it's riskier to do that. All right, but overall, the amount of time you need to retire has now gone down to 14 years. So gradually, as your models become better, you are making it easier for you to retire, right? So that's how retirement planning works. Of course, now you say that, well, now that higher dividends get us somewhere in life, then can I pick like other strategies to complement my dividend strategy? And as a matter of fact, there is computer software out there that allows you to do that, right? You can, for example, pick dividend stocks followed by stocks that have a high net profit margin, that are cheap and have a low price to book value, all right? You can do that. And computer software, which I cover adequately in my course, will show you how to combine these signals together and make a choice, right? And you find that when you shortlist 8 stocks with the highest dividend yields, lowest price to earnings ratio, lowest price to book ratio, and the highest profit margins, you will end up with double-digit returns of about 10.2, right? And when you are able to reach this stage, most of the time is enough, right? You can sort of complete your retirement process within 11.1 years. Okay, so this is how you humbly pick stocks in Singapore to actually improve the odds of retiring early, all right? But in order to do that, the model that you apply needs to become more and more sophisticated in order for you to do that, right? Yeah. Now, but you're saying that, well, Chris, I only have 10 years, right? You said earlier, how do I actually get beyond the 10-year sound barrier, right? Yeah. Now, to do that, you need to take a little bit more risk than the average investor, right? There are brokers that are willing to let you borrow money using a margin account to invest in the markets. So for every dollar that we have, we can credibly borrow $1 and leverage up to ×2 at a borrowing cost that's about 5%, right? Now, if you're able to do that and you have the courage to do that, even though right now I think we should wait for interest rates to drop before we start a margin account, this is not the time to do that. It's very risky, okay? But if you do that, your return can go up from 10.2% to 15.5%, which is actually quite good, right? Quite good, quite sexy, quite decent for many investors, right? And of course, at 15% returns now, you can credibly retire within a decade, all right? And what kind of stocks are you leveraging it? You get stocks like this that I have on the screen, right? Thai Beverage, the banks, real estate investment trust. These are very, very boring, very solid Temasek-like kind of counters that is actually quite safe, and a broker would be able to offer you a loan at a fairly decent interest rate if you use these stocks as a collateral, all right? And so to close our chapter on summer, retirement is possible if you're willing to level up your investment knowledge, right? We started out with a simple STI ETF strategy that didn't get us anywhere. But when we realize its weakness and we begin to balance out our funds between 30 counters, we get a decent 4% return, right? And if we were to shortlist counters based on the high dividends that they produce, then we increase our returns further, right? And if we come up with more sophisticated factors, combining high dividends with high profit margin, low PE and low PB, we can get double-digit returns with our formula. And finally, if you're willing to actually borrow money from a broker to be invested, then you can come up with returns that are very spectacular at 15.4%, right? But that requires taking a certain amount of risk, okay, that actually only young people have the ability to take, all right? Yeah, so retirement is possible if you're willing to level up your investment knowledge. So summer is about how you can apply knowledge to gain an edge, and summer is a very good time for you to actually build up your wealth. So now we're on to our third season, which is the season of autumn. And autumn is the point of time in your life, right, where things begin to slow down. and your happiness reaches an all-time low. So for me, my career began to take a dive quite early in my life. Just at the beginning of autumn, right, I started to make my first career mistake. When my daughter was born, I wanted to jump to the public sector to actually get more work-life balance. But in the process, I ended up working in a very toxic kind of work environment, where there was a very elitist kind of scholar-farmer kind of divide. And I had an argument with senior manager over a technical issue, right? And he was losing the argument, right? So in order to get somebody who's technically proficient to handle me, he brought the scholar into a room, a young 20-something scholar who came out from Cornell University, excellent data scientist. And he said, who is right, Chris or me, right? And that was very unfair because I was a mid-career hire, I was new, right? And of course, being engineers, we say what we need to say, right? We don't lie about the technical capabilities of something. In this case, it's a programming language called Ruby on Rails. And here's a funny thing, right? You think that the scholar would side with the senior director because the scholar has his career to manage, right? But in this case, the scholar said, yeah, I can code in that language too. Chris is right. You know, the language can do this. It can create a website with a functional database with one line of prompt command, right? Yeah, and you thought that winning an argument would mean that the scholar will now have to fend off the attack from this senior director, who's actually a very difficult fella to work with, all right? Yeah. Yeah, but no, right? Because he's a scholar, he's a blue-eyed boy. The director gracefully let me win the argument to carry on with whatever I was planning to do, right? And that was when I was very, very upset, right? Because I had 14 years of working experience, and basically no one would trust you. They prefer to trust the scholars, right, within that department, right? So I knew this was the wrong move, right? And then a couple of months later, I got called into a glass panel room where I was just shouted at by my insane lady supervisor. And it took me a while to calm her down to find out what was wrong. And apparently she was upset because I launched a project very quickly, right? And I didn't go through the formalities, right? So I said, look, if there are formalities, then the formality should be listed somewhere in the documentation for me to follow through. And I've been asking for the documentation for a while, right? And if you can supply the documentation to me, then what I'll do is that I'll backtrack and I'll complete the documentation and the project can run ahead, right? Because the customer is a ministry and you cannot keep them waiting, right? Yeah, and instead of helping me like an adult, my manager continued shouting at me. At which point of time, I finally lost it. You know, I said, look, you can't help me solve the problem, right? You guys don't have the documentation. Fuck this shit. I resign, right? And finally lost it. Okay, yeah, and it was at that time, right? I realized that I've had enough. Okay, I apologize. I've used the F word. All right. It's time to fire your boss, right? And let me talk a little bit about the maths behind it. So by then I already married with kids, all right? So this is my home expenses, all right? This is my take-home pay from the job at the agency. My dividends was in fact higher than my take-home pay. So at least I know that when I fired the agency, my family will be well looked after, right? My dividends would be able to sustain my young family. Okay, and so I was able to just walk away. Now, to be fair, some people would have retired 7 years ago, right? And then maybe they didn't start a family. And that's a lot to do with the FIRE movement, right? In Singapore, a lot of young people think it's very cool to do that. But for me, because I enjoy IT work, I carried on for another 7 years, right? So I was able to build up my wealth to a fairly substantial amount, right? So I had the kind of freedom to be able to do that. Okay. Okay, so what did I do? Right? I was in my 40s. I didn't need a job, but that's a very, very early time to retire, right? I don't think I can do nothing and I might develop dementia, okay? So I did something which a lot of IT people are unable to do. I made an application to SMU, and then I studied law for 3 years under the Juris Doctor program. Then I got out from law school. I got admitted to the bar 4 years later, right? So the question is, what am I doing here teaching investing? Well, the fact of the matter is, and it's something which I hope that my listeners, you'll be able to understand, is that reinvention in middle age is very, very hard, right? When I came out, I was facing some ageism. Most of my modules were commercial law, right? They concern things like insolvency, securities trading, mergers and acquisitions, right? I studied these modules because I had a passion for them. But because I came out as a 45-year-old lawyer, the work that I was able to find mainly involved the ones which are not very appropriate for people who spend an entire lifetime working with servers and working with computer systems, right? I dealt with divorce. I have to deal with criminal law. Criminal law, personally, I find the clients unpleasant. All right, I'm sorry I say that. There's a criminal lawyer listening to me. Sorry. Okay. For divorce is actually even worse, right? For divorce is emotionally very draining for me because I have a family of my own and I'm seeing what people do to their families when they decide to get a divorce. So it was quite difficult for me. The emotional burden was bad. So when I completed my practice training, I remember I ran out of the office and I never looked back, right? I became an investment trainer. Now today, okay, not only can you find me conducting investment courses, I do teach law in a polytechnic, so I'm an adjunct law lecturer. All right. Okay, a little bit about what I did in law school. There were a lot of Bloomberg terminals in SMU. Nobody uses them. So instead of studying law, well, I got decent grades, but I spent a lot of time doing all these experiments on investments. So I was able to come up with some of these strategies that will be able to generate double-digit returns. And I realized that in Singapore, even if everybody's average performance is very bad, you can select stocks to give you a slight edge, right? Now, on top of it, I solved one of the biggest problems that people have when they're trying to reinvent themselves after they lose their jobs, right? I find that for a lot of people going through their advanced degrees, they have a cash hoard, right? When they sign up for the program, they will go to school, they will continue to spend down their savings. And at the end of the program, they run out of money and then they are forced to find a job, and then they start a career afresh all over again, right? So that was the standard paradigm. So what I did was, I took a different strategy. When I went into law school, I applied leverage to increase my dividends. So I was able to increase my dividends by about 30 to 40%, right? Increase my dividends safely. And so that allowed me to not just pay for my living expenses for my family. I was able to pay my law school fees. I was also able to pay for my mortgage for my executive condominium, right? And I was able to graduate with a net worth that is higher than the day where I got into law school, right? So that allowed me to actually sleep at night during law school, but also, look at the legal industry very, very carefully and decide whether, given my advanced age, right, whether it is suitable for someone like me, right, to go into chambers and then get ticked off by a registrar, all right, by a senior registrar. Okay, so that's very important, right? We need that kind of optionality in autumn to decide what we want to do in our lives, right? And so when it comes to talking about your autumn, obviously your cost of living has gone up this year, right? Inflation, well, down to about 2 point something percent, still on the high side. Okay. Remember that there are two hot wars going on. There's a war in the Ukraine, and now basically in Israel, there is an escalation of conflict, right? You find that oil prices have started to peak. And so all this is going to trickle down and affect your cost of living in Singapore. And of course, if you are looking for a job, jobs matching is very hard. I know the government, this National Day rally, they've put up a lot of all these incentives, they can even support you if you're unemployed for the first 6 months. Or if you were to get another diploma, you know, and reinvent yourself, they can pay up to $3,000 a month, right? But the truth of the matter is that people just want employment, and jobs matching in their 40s is very difficult, right? So that's one of the bigger problems that I think we are facing now when the tech sector is not doing all that well right now. So it's not really a bed of roses, especially for tech professionals, right? So you could possibly end up with very much lower pay or same pay, more toxic kind of environment, right? There's ageism and jobs discrimination, okay? And you find that even in government data, right, when you're looking at people for every year of working experience that they get, you can get a 5% increment on average, okay? But once you hit 45, it goes flat, right? So there's probably some evidence that maybe the markets are not into people who are 45 years old, and there's some discrimination. Like for me, I'm going to be 50 years old at the end of this year. You know, I continue to have job interviews to make sure that my skills are recent, you know, because I'm constantly learning new things. I code, I do prompt engineering, I update myself on the latest insolvency law. You know, there's a lot of updating to do, right? So sometimes I just test myself, right, by attending some job interviews. Right. And generally, actually, the bigger companies are more open-minded, but it's the SMEs that don't really like older people. Okay, we're part of the sandwich class. We also have to divide our support between parents and children. And so you see the National Day Rally as something that is a further development from what happened in 2020 when the People's Action Party lost Sengkang and current PM said that it is the middle-aged voters feeling economic pain, right? So now they're trying to win you back, right? Okay, yeah. So I think the primary concern for people going through autumn and you're listening to me is the question of what happens if you're no longer at your earning peak and you're facing retrenchment in the workplace, right? So it's not so fun anymore, okay? And the autumn myth is investing is too complicated. It can distract you from the realities of your life, right? And the truth is that really strange things and bizarre things happen to dividends counters. So if you are a dividends investor, one of my favorite counters is Sabana Industrial REIT. It's done really badly in the past, okay? But I can say that it currently delivers about 7% dividends. And the beauty is that the delivery is in Singapore dollars, so you don't have a lot of forex risk, making Sabana easily one of the most attractive real estate investment trusts, if not for the fact that we basically gang up together to get rid of the management, to internalize the management for the company, right? And so investors have suffered for a very long time, okay? We've gone through one EGM lately to amend the trust deed. So the trustee is still throwing a lot of obstacles our way, okay? So, but the thing is that I think for investors like me who are holding on for dear life, the upside is that we want an internalized manager. We think it's cool to have one, right? Yeah, and so we can be as successful as the REITs in the Hong Kong that have an internalized manager, right? Where there's alignment between the manager and the investor, right? So this is a very complicated REIT, right? If you think about it, okay? But I don't think there is a need to really go into such details of an investment, all right? A simple way is when you want to think about dividends, right? It should be outcome driven, okay? And the best outcome that you can start now, if you're listening to me, is to find a way to aim for at least $100 a month in passive income, right? Now, suppose on the newspaper, you find a portfolio of dividend stocks that give you 5% dividend yields, which you can do so if you open up your business times today, right? For the STI, right? Suppose you're able to do that. Then all you have to do is to calculate how much you need to get $100 on average a month, right? And so it is 100 multiplied by 12 divided by 0.05, and you get $24,000, right? And that means if I can set aside $24,000, I can get an additional $100 a month of salary, and I can try out the idea of dividends investing to see whether it suits my personality. Now, it's not going to be suitable for everyone because some people like big wins, right? That's why they buy Toto and 4D. Okay, but dividends, these are very small wins, but they occur on a regular basis, right? And even if you never go further, that means you leave the $24,000 in your stock market account, your CDP, right? It will continue to give you money on average $100 a month, right? Yeah, in reality, it'll pay you $300 every quarter, right? Now, this $100 a month is very useful because it can pay for a Netflix subscription, it can pay for a ChatGPT premium account, right? And effectively, you have a golden goose that lays $100 of passive income using $24,000, right? Achievable with $2,000 saved every month, right? Pretty good, all right? Pretty good. Okay, but more importantly, your salary goes up by $100. So it's actually easier for you to get your next golden goose, right? Because you have more income coming in. It's like getting a $100 raise. And now, it's easier for you to attain your next golden goose, right? And that's how you scale up your investments. You increase the number of golden goose you have. And this is how you actualize compound interest from the practical perspective. All right, so the tip in autumn is get your first golden goose, achievable within a year with $2,000 saved every month, and it generates $100 of passive income for you. All right, easy peasy. Autumn is about taking stock and developing resilience in your life, and there is nothing better than coming up with an alternative cash flow. It doesn't have to actually cover all your expenses, but having that $200 every month, right? It's very useful, right? If you're unemployed, maybe you retrain, right? But you also have $200 to $300, providing you with a little bit more extra allowance every month, so that it's easier for you to sort of reestablish yourself with a new career later on. All right, so that's like autumn. Okay. So now we've come to the final season, which is winter, and this is where you enjoy the fruits of your labor and your happiness goes up again, right? I've not started winter yet, but this is my life so far. I travel about once a year with my family, right, using the dividend payouts from my investing, all right? But I think more importantly, right, we should be using financial independence to get freedom and simple living, right? And there is no better simple living than having a kaya toast and a kopi guyu, right, in the middle of the afternoon at lavender, right, and having no one to be able to control your time, right? That's important. On top of it, I have a closer relationship to my son because I get to see him every day. I bring him to and fro from school, right? And the second example was my dad. When he was in his final days in the hospital, I was able to visit him like every other day and inquire about his status by speaking to the doctors face to face, so that they know that this patient has somebody looking after him, right? And that kind of freedom is very difficult to attain if you actually have to seek permission from your company to actually let you go and do that. And this is something which I think a lot of middle income people we have to face, because the whole point about autumn is losing your parents, right? We tend to lose our parents in autumn, unless in very rare cases where your parents are very long-lived, right? Then you can like lose your parent in winter. By then you've become a grandparent yourself, right? So from the age of 55 to 65, you're expected to have your expenses drop by about 30%. And you find that most people will spend their money on food and beverages, household furnishings, and health, right? And this is where older people would need to be really concerned about, right? A lot of your medication expenses is going to go up, right? Medical inflation is a problem. And of course, in Singapore, we have this problem of longevity risk, where Singaporeans have the longest life expectancy at 84.8, but you're healthy up to 72 years. So living too long, becomes a possibility. You can become a burden to your children, right? Now, this is an important slide. If you are a good citizen and you follow the government and you have a full retirement sum in your CPF Life, right? Under the standard plan, you'll be paid $1,150 a month, all right? However, according to academic research, a 65-year-old today requires $1,421 a month to attain a basic standard of living. All right, that's about $1,500, close to $1,600 in 2024 dollars, right? So very likely, right, even if you have $200,000 in your CPF, you're not going to get enough money to sustain yourself from 65 years onwards. And so you might have to find a way to supplement the difference, right? One method is to get money from your children. Another method is, like many unfortunate elderly people, they go back to work, all right? So that's something that you need to understand the limitations of our government system. Okay, but the good news is that's what we are here to do, right? We show you how to use dividends to make up the shortfall. So what happens at this stage will depend on how well you play your previous stages in your life, right? You reap what you sow in winter, and winter is coming, right? Okay, the myth in winter is that market crashes can destroy your life. I'm not going to talk about the latest market crash. I'm going to talk about the Great Recession of 2009, all right? During that time, I was financially dependent. I was working. I was earning a decent salary at the time, okay? And markets began to fall, right? And when markets began to fall, I started to take my entire take-home pay and I farm it back into the stock market, right? I did it continuously. And I was the butt of all jokes because I've lost a BMW to the stock market and my colleagues were not invested in the markets. They were laughing at me, right? But I know something that they don't, right? I know that the longest recession that we've ever had, right, was the Asian currency crisis. And that lasted 706 years, 706 days, sorry. Right. Okay. And so I was in the middle of this global housing bubble burst, right, that started in the US. So I was thinking that if I were to just keep farming my salary into the stock market, when the stock market recovers, I would be rich, right? And the stock market will recover within 2 years, right? And so that was exactly what happened. The stock market recovered in the year 2009. And my friends stopped laughing, right? They became flabbergasted when I told them that, hey, remember the BMW I lost? Came back as a Maserati, right? Yeah, so market crashes are your ally in wealth building. If you look at the real estate investment trust when there was a crash, right? Yields were double digits, right? You could get 18% with Ascot. Suntec was giving 16%. Even Mapletree was giving 15.9%. If you were to invest during that period of time, you will emerge from the downturn a millionaire, right? And markets are a lot more attractive now. We're getting yields, I think, within the range of between 9 to 10%. If you're willing to take a bet on some of the US counters like United Hampshire REIT, one of my favorite REITs. Okay, and I think ESR is giving about 9%, 8 to 9% right now. So actually, there are very, very attractive options in the real estate investment trust. And actually, there's a lot of good news, right? The Singapore Monetary Authority now wants to set up a review group in a bid to revive its equities market. So you could be seeing a higher price to earnings ratio moving forward. So I can see that this over the next 2 to 3 years would probably be able to increase the markets at least, right? I think 8 to 10%, right? If we are being conservative. On top of it, the time has come to lower interest rates, and that's very important. And this is what the Fed Chair Jeremy Powell has said. And actually, if you look at the portfolio that my students have designed, right? They've actually reached a turning point recently, and it's already on the way up. All right. So you do not need me to really talk about this because you can read about it in a newspaper. So actually, this is the best time to actually get to these dividends heavy REIT kind of portfolios. All right. Okay. And now when we invest, we are no longer reliant on human beings to generate these financial analyst reports, right? I have, in fact, as part of this program, trained and produced about 6 to 7 prompts that can be used to generate like technical analysis, right? Information, so that we can have a very deep level of understanding of the stocks that we want to study without like the support of like a brokerage firm, right? So finally, winter tip: market crashes are your ally in building great wealth, right? Winter is about cherishing what you have, cherishing your time, and enjoying yourself. right? So basically, we've spent the evening talking about four seasonal truths to counter four myths. All right, let's run through them again. Your X factor can come from reading popular finance books like Robert Kiyosaki. Actually, no, right? You need to invest the time to learn finance the hard way, right? You need to get into some numbers, right? There's no way around it. Retirement is impossible unless you listen to a financial advisor. That's not true. Retirement is possible if you're willing to level up your investment knowledge, right? You need to understand things like how to improve returns. And the other thing you need to understand is how rich people become richer, right? Through the power of leverage. Thirdly, investment is too complicated and can distract you from the realities of life, right? Actually, it's as easy as getting your first golden goose, right? You don't need to over intellectualize this. And market crashes can destroy your life, all right? And finally, market crashes are your ally in building great wealth, right? So these are the four seasonal truths to counter four myths, all right? And what am I really driving at after this spiel on the four seasons, right? And the truth of the matter is that the Singapore dream is dead, right? I think it was declared dead during the National Day rally this year, right? And you look at the traditional advice about going to school, getting good grades, getting to a profession by a good honors degree, then getting a good honors classification, getting a steady job, working your way up, accumulating the 5 Cs. After you retire at 65, collect CPF life, right? This formula is rapidly failing us, right? And we need a new kind of Singapore dream. You know, it's so difficult to survive in school these days with all the exams. Not every university is a good university, given that there are now 6 universities in Singapore, right? And likely a 7 arts university coming up, right? As you get a job, your jobs are unstable, right? As you work your way up, there is politics, right? And then you accumulate the 5 Cs, which can be expensive and can detract you from retirement planning. CPF life is not enough, right? Now, we need a new Singapore dream. And I suggest that we discard the 5 Cs and just get 1D, right? Which is dividends. And this is what dividends can do for you, right? It can support your children's education, have them focus on a paper chase, ease minor expenses, smooth out lumpy salaries while you settle down on a corporate workforce, address sudden expenses related to children's education, cope with retrenchment, hedge longevity risks, pay for medical expenses, and finally prevent yourself from becoming a burden to your children in winter, right? And dividends show up on your bank account on payment date. If you're a DBS account holder, it shows up at around 5:30 p.m. The money will just arrive even if you're lying in bed in a coma, right? And more importantly, if you sustain this over more than a decade, you can get these results like mine, right? I recorded my dividends during the early part of the pandemic when the market was crashing. And I was able to get $80,000 over 6 months, which is about 13,000 a month, right? And this is based on a portfolio with a size of about $2.4 million. It runs with a yield of about 6.6%. And if you were to take the same amount and you invest it in a condominium, right, you will get about $5,500 to $6,000. And this is close to double the household needs of a median income household in Singapore, right? All right, so we've come to the end of the first part of our workshop. We will take a 5-minute break, right? And we will come back at 8:43 where I will talk about the early retirement masterclass. All right, so take a short little break. I'm going to get more water and I'll see you 5 minutes time. Okay, welcome back. All right. Now, for the next 20 to 30 minutes, I'll talk a little bit about what the Early Retirement Masterclass is, all right? And after that, we will have Q&A, all right? And I'll answer some of the questions that you have. So what is the Early Retirement Masterclass? It's a 5-day course to recapture the Singapore dream. The first objective is to assist you in transitioning into an independent and successful DIY investor with support from a community of like-minded investors. The second objective is to create a secondary source of income that will meet your lifestyle needs. And the third is to gain the ability to use a new data-driven framework to grow your portfolio in ever-changing market conditions. All right. What is our final objective? We want a portfolio of local stocks, 15 to 20 counters for diversification, right? It contains blue chips, REITs, and business trusts designed to provide 5 to 6% dividend spread across the year, consistent with our view of the market cycle. Minimum monitoring. Build once, leave it along for at least a year. But most importantly, right, this is the portfolio that you will ride for the recovery of the Singapore markets when interest rates begin to go down. All right. So that's exactly what we do. All right. Now, how do we prepare our students? 4 days of foundational training online over Zoom like this from 7:30 to about 10:30 every evening. All right. Then on the 5th day, we will meet face to face. I will be assigning you into groups. I'll be giving you a stock to actually study. And then after that, you need to decide whether is the stock suitable for investing into a portfolio. All right. So after you've performed the discussion and you've built up your research, right? The portfolio will then be launched the following Monday. All right. I'll launch the portfolio the following Monday on my own brokerage account. Okay. Now, these are just some sample snippets of what I teach to show you that this is actually a hardcore training course, and it will give you some very solid skills on how to navigate through the stock market. All right. Now, what is special about our program? We have a bespoke tool, a web application that can turn a class into a room full of investment analysts. All right. So students will perform data entry. The software will then consolidate the research of a classroom full of students. Thereafter, the software will then perform mathematical calculations and produce the dividends and the various mathematical properties of the portfolio automatically. All right. So you don't have to do any number crunching when you're part of the program, right? We will participate in 2 rounds of portfolio creation. We will do 1 round with blue chips and 1 round with real estate investment trust. Okay, so this is a sample of the kind of portfolios that my students are trained to build. All right, this is a portfolio of about 15 to 20 stocks built 3 years ago. And what my software will do is that it will tell you whether it's on a rising or falling trend. All right, very, very important, very, very useful. All right, it will also calculate for you what is the dividends that you can expect in the future, along with all these complicated statistics, right? Which I will sort of explain what they mean, all right, as part of the program. Okay. All right. Now, likely, right, we're the only investment course in Singapore that is LLM centric, large language models, right? This course will teach starting in September prompt engineering, right? So they can make intelligent investments into local stocks. And the methodology is backed by a groundbreaking paper from Marquette University, all right? So probably the only course of its kind here. You won't be able to find this anywhere else. This is a sample of an output for one of the analyst reports that I've been training to ChatGPT to generate. All right, so students would have to sort of subscribe to ChatGPT 4.0 in order to generate documents with such an output. All right, and of course, back to my program, every single investment decision will be documented and then sent to the class at the end of the program. All right, so here's a sample of what's written about Netlink Trust, okay, which is a very good defensive play and has a very, very pivotal role in many of the portfolios that my students have built. All right. Okay, and finally, it's actionable by beginners, right? You have students who want to learn how to fish, so we will teach you how to fish. But there will always be students who just want to eat the fish. And what these students will do is that they will take the PDF and then they will execute in the markets the following Monday. Yeah. Okay, with the sample return of 17% that I've shown earlier, right? Students can credibly get out of the rat race within 10 years without the use of leverage, right? And the odds of this happening now is higher than before because we are the tail end, right? Interest rates are not going to rise any further. So we can expect the returns to be even higher than what we backtested earlier on, all right? And as it turns out, the kind of dividend stocks that we build in this program would actually mesh and synergize very well with CPF Life so that CPF Life can produce a fixed amount every month, but your dividend stocks will produce an amount that will grow with inflation, right? And on an annual basis. So if you have $1 million with 30% in CPF Life and 70% in local dividend stocks, you could be looking at about $4,500 worth of passive income every month, all right? So this is the kind of portfolio that's very useful for people to do retirement planning. And the relationship continues after the course, right? We have a Facebook group where students are enrolled inside. We've got 600 plus alumni now who can assist with questions. And I'll be updating everybody in the community on a regular basis. Okay, and the most valuable thing is that you have lifestyle access to the portfolios built by other students. All right, so if you attend the class in September, you produce a PDF, right? And it contains stocks to buy. The Facebook, if you hang around in the Facebook group, which is free, right? Lifetime. In December, when I complete a batch of students, you will get another PDF and so on and so forth. Some students have been there for the past 6 years, right? And this will occur so long as I'm conducting the course, right? There is no monthly membership and there is no advanced upsell of courses. We have a one-tier kind of fee for our program, right? Let me explain a little bit about conflict of interest. So normally I try to tie my performance with the student portfolios that we build, all right? And I generally will try to invest part of my own course fees into a portfolio designed as part of this program. So this ensures that the instructor will be able to benefit if you make good investment decisions. And I will obviously be the first to suffer if your investment decisions are not right, okay? And this comes from the book Skin in the Game by Nicholas Taleb, all right? So I'm a big fan of Nicholas Taleb. All right, now the course has some prerequisites. Now, if you want to make money from an investment course, you should have some capital. And so the recommended capital would be $10,000, either in your CPF, your SRS, or in cash, right? We also, if you do not have capital, then maybe you should have a day job that pays you at least $3,000 a month so that you can credibly build up your investment portfolio over time, right? I need you to be able to operate a laptop and a mobile phone, so it requires some IT and mathematical knowledge, but lower secondary school maths, plus, minus, multiply, and divide, right? You need that kind of mathematical knowledge to be able to appreciate and understand my course, right? Here's a humble case study, right? Donna Darrington from batch 9 has made her first dividend within 16 days of attending the program. So when Donna came to us, she was in between jobs, okay? And this is Donna's lady on the right, by the way. A lady on the left doesn't need investment courses, right? So I got Donna to get into Netlink Trust and she was able to get some money later on. And so that gave her the confidence to understand that it's possible to build up a portfolio that generates income on a regular basis. So when I met Donna sometime later, internal rate of return was quite good, right? And she was able to get her first golden goose within a year of attending the program, right? All right, so at this stage, right, what is the value of your financial freedom, right? If the cost takes you 20% towards your retirement target of $500,000, then that you'll be about $100,000 richer. At 20% of that, the cost should be worth at least $20,000, right? And on the right side of the slide, you see how we describe the strategies that we teach in our program. You will receive a portfolio summary of the list of stocks that has been chosen by the class, right? And you'll be able to understand what their performance was like for the past 5 years, and more importantly, how much risk the portfolio will generate for you. All right. So to do that, similarly, you need a Bloomberg terminal and probably months of training to use Bloomberg, and that will set you back a 5-figure sum. We have a beginner's guide for people who have no experience in trading, and we will show you how to get at least a trading account on DBS Vickers, right? So that kind of hand-holding can be worth thousands of dollars, and you just get a document and then you can read before the course. And we have a network of partners, right? The people who run the platforms to help you in managing your portfolio that allows you to perform fundamental back testing. These are all students of my program, all right? And the software subscription required to do this is less than, I think these days is less than $10 a month, less than $10 a month, all right? Stocks Cafe and Quants Cafe, right? And students get discounts when they sign up for these platforms. Okay, and finally, once again, the Early Retirement Facebook group, membership for life, have access to me, pay once, and you'll be able to participate in all the updates to the program for the foreseeable future. All right, so this is probably priceless and probably what makes the course one of the cheaper programs you can find in Singapore. Right, our next program will begin on the 10th of September, which is not too long. All right, and during the evenings, we will cover the basics of personal finance, understanding the economy, how we invest in this course, right? Then we go through different asset classes, fixed income, blue chips, small caps, growth investing, REITs. And then we will talk a little bit about leveraging your investments, followed by how to tie everything up with government schemes like CPF and SRS, CPF and SRS. So this is an early retirement program. We have to cover traditional and conventional methods of retirement, all right? So you can understand how everything works. On the 5th day, 14th of September, we will show up and meet together where I will guide you towards portfolio creation, and we will have a final exercise to reinforce everything that has been taught in this program. All right. Summarizing everything that you will pick up, the value is easily $44,000, right? The course is priced at $3,888. And if you were to express your interest with Dr. Wealth by filling out a form right now, right, we have a promotional price of $2,568. If you use a credit card to pay by installments, it is about $200 for 12 months, right? You have enough capital to get 2 golden goose, right? Then the 12 months installment can be offset by the dividends you receive from the portfolio, all right? So imagine this, right? If you have $100,000 that you can invest in the stock market, right? After this class, the dividends alone would get you about $5,000 a year. And we're not even talking about the capital gains that will start happening in September when interest rates start dropping, all right? So this is probably, there is no better time to sign up for this program. Come for the first day of the course. If you're dissatisfied with what you're learning, you feel that this course is not for you, feel free to exit and we will refund all your money back. Let Dr. Well know that you want a refund, right? Just don't come for the other days of the seminar, all right? So if you commit within the next 72 hours, we even have a free package for you. All the 3 books I authored in PDF format, a collection of beginner readings on the Dr. Wealth website, and 2 bonus lectures, right? All this will be given as a sweetener package if you sign up over the next 72 hours, right? Our course timing, all right? 10th to the 14th of September. Our price, $2,568, all right? Okay, we're not done. I still have about 3 or 4 slides before I finish, but what I'm going to do now is that I will do my best to answer any of the questions that you have about the markets. All right, I'll do my best to answer, okay? And let's see what we have, all right? Okay, Elliot Low, I saw Dr. Well, one of the videos on the docs of the STI, does it work? Generally, moving forward, it should work, all right? And the reason is because interest rates are going down, and stocks that give a decent dividend, right, the price is likely to go up, right? It's likely to go up, right? And for real estate investment trusts, when interest rates go down, they pay less for floating rate loans. And so the amount of money that's available to be given to shareholders will also go up, all right? So Elliot Low, I hope that answers the question. DC to everyone, how much to invest to get 1,000 per month passive income from dividends? All right, so for about 1,000 a month, it is approximately $12,000 a year, okay? And at $12,000 a year, we are talking about $250,000 to $300,000 to be on the safe side, all right? So you might want to add towards $300,000 to be able to generate dividends of about 1,000 a month. All right. Okay. But if you were to follow that 24,000 rule, that would be 240K. All right. 240K to get $1,000 of passive income on a monthly basis. All right. Is rental income a good source of stable passive income? Yes, it is. All right. The problem with rental income is that it is very lumpy. You need to own the entire unit, right, to collect rental income, and you get income from one source, right? Whereas if you were to invest in dividends, your rents come from multiple sources. The other problem is that when you collect rental income, the rental income flows into your personal income and is taxable as personal income. And the property that you own will also be subject to property taxes. All right. So it might not be a very effective way of generating passive income. All right. Most people who buy real estate invest for capital gains. All right. Invest for capital gains. All right. Winston Lock, is the 0.6% annual STI ETF growth total return? Yes, everything in my slide includes dividends and capital gains. All right. Elliot Low, what if you miss spring and summer and reach autumn? Is there any way to do your catch up? Actually, that is very common in Singapore, right? People who didn't do a lot in spring and summer, and then you find that you need to catch up in autumn, but you're facing all these problems at work, right? Retrenchments and then reskilling, right? And then re-employment, right? The whole point is to get into early retirement to avoid this problem with autumn. But if you're stuck in autumn and if you still have a job, it's fine, right? You can still generate dividends, and $100, $200 is useful. Now, remember what I showed you on my slides. If you have the full retirement sum in your CPF, you generate $1,150. And then I demonstrated that there is a $300 to $400 shortfall, right? So if you can somehow work and build up $100,000, that's 4 golden goose, right? 4 golden goose, $400 a month. It will be just nice for you to bridge the shortfall after the age of 65. Then all you have to do is work until you're 65 years old, right? So actually it's not so bad if you reach autumn, right? And my course attracts a lot of people in their 50s to learn about dividends investing, all right? So you can definitely do that. Ko Eng Beng, do you invest the dividend or spend it? For me, I invest most of my dividends, all right? I have a 5-digit dividend payout every month, but I continue to work as an investment trainer. I also work as an adjunct lecturer in the Polytechnic. So actually, I save most of my dividends, all right? And the thing is that I have children who are quite young, one in primary school, one in secondary school. I'm obviously concerned that, if they are not able to get into a local university, I have to use my dividends to support them in Australia, all right? So that is why I'm saving more than what I should normally save lah. All right. And but the truth is that I spend very little money because I'm quite frugal. Okay. Alan Ong, does all these US REITs have dividend withholding taxes? They don't if you fill up this thing called a W8 band form. All right. You fill up a form and they will waive the withholding taxes. Okay, and it's not too bad, but you have to buy them on the Singapore Exchange. All right, and the Singapore Exchange will then advise you on what to do. All right, so you don't pay the withholding taxes when you buy US REITs. All right, Daniel Wong, using leverage, Chris, you are using ×1, ×1.5, ×2. Okay, the example I've demonstrated on the slides is ×2. Okay, my students seldom exceed 1.5. All right, my students seldom exceed 1.5, and my students have a reputation in the industry. All right, the brokers know that they are my students because they are very conservative. You use Kim Eng for the margin account? Yes, I do. I have Kim Eng and I have Interactive Brokers and I play between 2 accounts. All right, and I'll teach you guys how to use Interactive Brokers in my program. What are your thoughts compared to dividend investing and index fund investing? I do both. I conduct a course on how to use momentum indicators to trade the index funds. I also conduct dividends investing. Okay, I became notorious or famous because of dividends investing. Okay, but index fund investing is great as well. All right, my students are not taught to say that a particular method doesn't work. I think all methods are good. Okay, dividends investing is good because it naturally provides passive income into your bank account. But generally, dividends investing has a higher drawdown. All right, so you need to be able to sort of live with some capital losses, but they will eventually recover. Maytan, we are always told to diversify our investment. Is putting all dividend yield stocks considered diversified? It is, provided that the money comes from different sources. NetLink Trust, the money comes from fiber cables on the ground, right? Asia Pay TV Trust, the money comes from broadband, all right? Your United Hampshire REIT, the money comes from groceries. DBS, the money comes from banking, right? They have to be diversified, all right? If you put all your money into, for example, industrial REITs, right? Well, you will suffer when the industrial sector does badly. Okay, so we do build diversified portfolios. Alan Ong, can I get $10,000 of passive income a month? Wow, in 10 years or less. You can do it, but your pay needs to be very high. Yeah. I wasn't able to get 10,000 within 10 years or less. I was not able to do that. But if you are a high earning person and you set aside maybe 70 to 80% of your take home pay, yes, you can credibly get $10,000 of passive income a month. All right. So it's not impossible. And there are many influencers and all that you find that are able to do this. All right. So I'm not, it shouldn't be me telling you it's possible, it should be them. Okay. I was not able to do that. All right. I was able to get 10,000 after more than 14 years, right? After more than 14 years, okay? All right, and yeah, you can let it compound, and if you want it to compound faster, you have to risk leverage, which is not for everyone, right? You have to consider the ability to use leverage in your investments, right? Okay, so I think I've answered all the questions here. Now, if you have any further questions, you can write to Dr. Wealth's staff. They will direct the questions to me. All right, let me complete my presentation for today. Finally, the question you want to ask yourself is, where are the customers' yokes, right? If the trainer is rich, it is not enough, right? You want to know how the students do after the program. And so I've left the most aspirational illustration to the end of my program. And this is a power couple, right, who attended my course in December 2019. The couple, they are both finance executives, fantastic salaries, and the husband and wife farmed $30,000 to every portfolio built by the students from December 2019 to the present day. And it is a margin account with 2 times the leverage, right? And they've even invested through the pandemic. Okay. When I recorded their results, they have an internal rate of return of 10 to 11%. They are leveraged, so they were making 17% a year. Within 2 years of accumulation, the portfolio size is $1 million. Of course, it's leveraged, so half of them, they are owned by the couple, okay? But it's a lot of money, right? It's a lot of money for someone that has attended an investment course 2 years ago, right? And so I hope that with this example, you would be happy to reinvent yourself in 2025. Give yourself a chance to pick up some skills on early retirement. Let it change your destiny. Let this be your new Singapore dream. And I hope to see you in class on September the 10th. All right, good night and goodbye. Have a good evening. You've been a wonderful audience. Thank you.